Welcome back, everyone. We have an exciting and fun video to get into today. We're going to be talking about earnings reports. And as you can see here, this big wall of earnings reports, you can see a lot of important companies, a lot of big logos here. We got Microsoft, we got Google, we got Meta, we got Ford, Teledoc, Shopify, McDonalds, Apple, Amazon, Intel, Chipotle, Spotify, 3M, JetBlue, Wingstop. We have a lot of huge companies reporting earnings this week, both big and small. We have basically all of big tech, Microsoft, Google, Amazon, and Apple all reporting earnings, and Meta. We have a lot of smaller companies, consumer staple companies. This is a big week in earnings. In fact, this is by far the most important earnings week of the season. So this is it. This week will determine really how this earnings season went. We'll look back and see if companies did well, if they beat their earnings estimates, or if they did poorly, they missed it, and they're guiding downward. A lot of the market is determined by this week. I think it will determine a lot of the returns for the next 3 months. It'll change investor sentiment to some extent. So this is a big one. And what we're going to be doing in this video is I'm going to be going over all of these circled ones and giving my take and predictions on their upcoming earnings. I'll let you know if I think the companies are going to beat or they're going to underperform their earnings. They're going to come in lower than expected. And I'll also do an update on their fundamentals. So this is going to be a big one. We have a huge week to get into. Let's go ahead and get started with these earnings reports. This is the chart showing all the major earnings reports coming this week. And I highlighted the ones I want to go over. You'll notice I didn't highlight any today, Monday. I just don't think there's any interesting companies reporting earnings today. Sorry, but Logitech, Zions, Philips, these aren't that interesting. So I'm going to skip to tomorrow, Tuesday. We have UPS reporting earnings before market open tomorrow. Let's go ahead and bring this company up. And if you're not aware, this website we're looking at is called Qualtrim Insights. It is a data tool. It's part of the Qualtrim suite here. And all of this is included as part of the Patreon. So if you haven't tried out the Patreon, there's a link in the description. You're missing out. Go sign up today. I think you'll really enjoy it. And you have nothing to lose. It comes with a free trial, so you can try it out for free. It includes Qualtrim Insights, this website, as well as a whole Discord community. We have thousands of active members every single day using this stuff. And you get hundreds of exclusive episodes, most of them an hour long. 45 minutes to an hour long. So tons of content as well. So try out the Patreon. I think you'll really enjoy it. Now, back to UPS here. This company is a logistics company, and the reason that I'm not invested in it is I already own a logistics company that I think is far superior. The one that I own is called Amazon. Now, it's true that UPS right now is much bigger in terms of pure logistics than Amazon, meaning UPS has more planes, they have more aircraft, they have more trucks, they have a bigger breadth of logistics network, but Amazon is closing that gap rapidly. And Amazon has so many advantages over UPS with their powerhouse of income from AWS, with their retail business and Prime subscription, that I see them having so many unfair advantages over UPS that I really think eventually Amazon will engulf and consume UPS. I really think it will just cast a big shadow over them. So I'm not invested in UPS specifically because I'm so bullish on Amazon and their logistics business. Now, having said that, in terms of this company specifically and their upcoming earnings reports tomorrow morning, I really think that it has more chance for a surprise upside than downside. And the thing that makes me say that is a company right now is priced at a 12 forward PE ratio. You can see it right there. The forward PE is a 12.63. At a 12 forward PE ratio, assuming an 8% cost of capital, this company trades at a commodity multiple. A commodity multiple means that investors are literally pricing really no value creation or value destruction. They're pricing in that this company is basically going to be floating along, doing really nothing over the next 15 years. And in my opinion, that's very low expectations for this company. They are growing their revenue, they're growing their EBITDA, they are free cash flow positive, producing free cash flow every quarter. They have positive net income. Their balance sheet is actually improving over time. Their debt's going down. Their cash balance is going up. They're paying a growing dividend. And their shares outstanding are starting to come down over the past year. So being priced at a commodity multiple and having positive fundamental growth, I think it simply has more chance for upside. Now, I wouldn't bet on it. I think it's still a coin flip. If they give poor guidance and say that it's going to slow down more than expected or more than last year, then I think it will obviously, it'll tank in earnings. But if I had to give it odds, I really think the pricing of this company leaves more upside than downside. Now, moving on, we have CocaCola. Now, unlike UPS, CocaCola, a consumer staple with a wide moat, is a company I could see myself investing in. I've currently picked Pepsi over Coca-Cola only because Pepsi owns Frito-Lay, and I consider it to be more diversified and have more organic growth. But Coca-Cola is not a bad option. I'd be very happy with this one in my dividend portfolio. A lot of people scoff at Coca-Cola. They incorrectly say that the company isn't worth it because it's not really growing revenue all that fast and it has a high PE ratio of 21. So why do you buy an expensive company with low growth? What they're not really looking at is the free cash flow yield of 4.1%, the defensive nature of this company. It's basically indestructible. This is one of the few companies that will likely outlive everyone listening to this. This company will be around for another 100 years and thriving. It has just insurmountable brand value. They post growing free cash flows every single year. It's incredible what Coca-Cola is able to do. The company's fundamentals are so strong for so long, such a long duration, that it deserves a little bit higher PE ratio than most other companies. So that's the reason this one trades at a higher PE of 21. I think Coca-Cola's earnings are going to be good. That's my prediction. Again, don't know for sure. Don't bet on it. It's just my prediction, but I think restaurants are doing particularly well. This company has a lot of exposure to restaurants. You'll notice that restaurants either have to go with Pepsi or Coca-Cola. They have the exclusive deals with them, and most of them end up going with Coca-Cola. So as restaurant businesses are thriving, I think consumers are thriving. I think Coca-Cola is likely to post very strong numbers this quarter. That's my prediction. We have 3M as well, Tuesday morning. This is one, it's 3Ms, not 2Ms. 3M is a company that I have been interested in. It's in that industrial dividend category, but this is one that I've always avoided because I simply just don't understand the industry enough that I feel comfortable in this type of company. It's a conglomerate that sells so many different products. Most of them are industrial products like the sticky products, they're sticky notes, they're adhesives, they have air filters, right? They have all these different things, and I just don't understand the market all that well. So I've avoided this one because it doesn't fit in my circle of competence. I look at it and it's trading at below a commodity multiple. It's at a 10.8 forward PE ratio, and I think it's probably deserved. I think so. The company's growth has slowed down a lot. The free cash flow is starting to trend downward. I think they've ran into problems with lawsuits. They can do share buybacks. That's good, but they've been doing that for a long time. The balance sheet looks okay. The dividend growth has basically flattened out to almost nothing. They're probably going to start doing just the 1 cent dividend raises to keep on the records, but you can see the deceleration in dividend growth. And overall, it's just an industry I'm not too interested in. The returns on capital employed also aren't amazing. So this is one that in terms of this earnings report, it has low expectations, very low, but I still think this is a tough one to get on board. I don't like the fundamentals of the company right now. I know it's difficult to say that because it pays that high dividend yield. A lot of dividend investors love this company. It's just not for me. I wouldn't bet on this company. I'm not investing in it right now. Having said that, again, I don't understand the industry all that well, and that's part of the reason that I avoid it. I won't bet on this one. JetBlue is another company that I highlighted for a specific reason. I think the ticker symbol's JBLU. That's it. So we bring up JetBlue here. The reason I highlighted this company is to show an example of a company that nobody should ever invest in. That's the reason I highlighted JetBlue, because it is a airway company. It is a plane company. And this is a terrible industry. It's down 51% year to date. We have, over the past 10 years, a 36% return. Let me repeat that. Over the past decade, it's returned 36%. This is just a bad industry. It doesn't matter that it has revenue growth. That means nothing. Revenue growth with this company means nothing. They could grow revenue 100 times over. And the problem with this industry is revenue growth only matters when you earn returns with the revenue. And this industry does not earn returns with their revenue. The highest it's ever gotten in its entire history is in 2015 with 19%. That's like the lowest that Texas Roadhouse, a low ROC company, gets. This is the high end of this type of company. Most of the time it's 5%, 6%, 7%, which is the cost of capital. So this is a company that borrows capital at 8%, it reinvests it back at 7%, and loses investors money. And it's doing the same thing in 2021. In fact, the ROCE is below zero. So they're burning money right now, and it's just part of this industry. You can pick any of them, pick any Delta Airlines, any airline company whatsoever, and they'll have very similar economics. The interesting thing is these companies continue to attract investors because of the low PE ratio, but when you factor in the ROCE these companies are getting, you realize that they're just not worth it. It's not worth it. You'd have to be a market timer and try to time the downtrend and uptrend. And unless you're willing to do that, this is not the company to invest in. In terms of predictions, I actually think there's a good chance that their earnings won't go well. It's always a coin flip, but I think with the slowdown in travel, the consumer's probably strong over the past 3 months. So I think that they'll likely beat their earnings and revenue, but I think their projections going forward might be worse than expected. If we see a slowdown in consumer travel, let's go ahead and move on to Microsoft. This is a big one. I will say that I own a lot of Microsoft stock. So this is one I'm heavily invested in, extremely bullish. I'm looking at it through that perspective, but trying to stay objective on this company. It trades at a 23 forward PE ratio, which I think is too low for a company of this caliber. It's such a good company, trading at a relatively low valuation. A little bit above the S&P 500. The S&P 500 trades at a 17. Microsoft trades at a 23. I think it deserves the high 20s right now. And if we get into another bull market, I think this thing will be back up into the mid 30s. So the reason why is the company has explosive revenue growth. Now, again, revenue growth only matters if you can turn that revenue and capture economic profit out of that revenue. So in the case of JetBlue, as long as they're earning low returns, it doesn't matter if their revenue doubles. But in the case of Microsoft, their revenue doubling does mean a lot because they capture a lot of profits out of this revenue. We look at the returns on capital employed, and they're not 5 and 6%, they're 31%. This is on the very high end in the market. This is really good, and it's continuing to trend upwards. So this company has explosive revenue growth on top of high returns on capital employed. They have explosive free cash flow growth. The fundamentals look incredible across the board. I think Microsoft is actually the poster child of the perfect fundamentals for a company. Now, I'm going to give an odd prediction here, though. My prediction is that going into this next earnings report, it'll be underwhelming. It won't be as good as investors expect. In fact, I kind of see some downside with this earnings report. And I say that, again, owning over $50,000 in Microsoft. So heavily invested, but I want to give a caution on this earnings report. The big reason why is the FX headwinds. Microsoft is a global business that earns a lot of money outside of the US. With the US dollar being so strong, the currency outside of the US being so weak, the exchange rates, they just decimate Microsoft. The same thing we saw with Netflix. We have that same effect with Microsoft and these large corporations. So I think they're going to take an FX hit. You'll have to look at things on a constant currency basis. But my prediction with this is that's going to be something that overshadows the rest of their earnings report. In my opinion, I think it's a temporary headwind. I don't think it's something fundamental to the company. I think it's something that investors just have to sit through. But I think that will be part of the problem, probably the highlight of Microsoft's earnings report. Outside of that, I think it will be great. On a constant currency basis, I think it will do really well. But that's my rare prediction with Microsoft. Moving on, we have Google. We had another ad company report earnings and again drop the market and drop Google, which is Snapchat. I think Snapchat and Google are so different. I think it's funny that the market trades one or the other, but I do agree that there's probably some degree of ad weakness in the market. Looking at the analytics on my YouTube channels, the ad revenue per view has gone down slightly, so advertisers are pulling budget to some extent. That might pick up, but that's just part of the business here. You're in an ad business, it's going to ebb and flow in ad demand. I still think Google overall is a very strong buy long term. I think there's minimal downside, long-term upside. I think the company's undervalued. Going into this earnings report, though, again, I have to say, I think there's more chance for upside with Google, but the ad market just makes it a big unknown. I think they might have further deceleration in YouTube and their main search product. So I know it sounds like I'm not bullish on big tech. I promise you I'm bullish on Microsoft and Google, but I think in terms of this next earnings report, it's both a little bit questionable. I think with Microsoft, you're facing the FX headwinds. With Google, you're facing the ad market and the volatility of it. Right now, there are some advertisers pulling their budget. They're pulling spending. So we'll see how long that lasts. That's going to affect Google because that's how they make literally all of their income. Now, Chipotle is the next one. This is a Bill Ackman stock. He likes Chipotle. I think it's his biggest holding. This company's just been on fire lately. It trades at a very high multiple, a 36 forward PE. And that's basically the reason I don't own this company. I think it's a great company, growing revenue very quickly. It's down only 8%, so it's held up relatively well this year. They're actually free cash flow positive, so it's a food chain growing revenue quickly and EBITDAs and free cash flow. It has no debt right now, so completely debt-free, no chance of bankruptcy. And the returns on capital employed are very low, but I think this will go up like crazy. Every year, this ROCE is going to go up. So it seems like a very aggressive growth company. The thing I just don't like about this company is what's currently being priced into it. A lot of the earnings growth, I think, is priced in at a 36 forward PE ratio. And it's hard for me to jump in and buy a company like Chipotle when there's so many other great companies selling for a much cheaper PE. There's simply a lot of deals in the market right now. That's part of the reason I haven't bought this company. Now, their earnings report, I think, is going to be great. I think Chipotle has been packed. I think that consumers love it. They have money. They're probably eating it once or twice a week. I think it's going to do really well. I'd be surprised. I'd actually be shocked if Chipotle reported this terrible earnings result, that they missed all of their expectations and gave low guidance. I think restaurants are just doing really well. I look at my investment. I own a lot of stock in Texas Roadhouse, and I know it's not identical to Chipotle, but the wait lines are long. These restaurants are packed. I check the app, and I see how long it takes to get booked for a seat of 4, and I pick all different locations with all different zip codes every single evening. It's a 45-minute wait. It's just so long of a wait. So I assume that people have money to spend on restaurants. That hasn't slowed down, and I think Chipotle is going to benefit from that. Next up, Tuesday after close, we have Spotify reporting their earnings report. Spotify was a company that I owned at one point, and I decided to sell out of it. That sell has so far been a good decision because it continued to plummet in price. The reason I sold Spotify was despite the fact that I love the product. And I think that Daniel Ek is incredible, the CEO of the company. The company's growing like crazy. I've highlighted this again with JetBlue, and I'll highlight it again with Spotify. Revenue growth is only meaningful. It only matters if you can capture the economics, if you can capture profit within that revenue growth. But if you gain $1 in revenue and all of that money has to go to expenses, the revenue doesn't mean anything. And that's where you get companies that have a below 12 PE ratio. They basically don't capture any economics of what's going on in their business. And Spotify falls into that trap. They're growing usership, they're growing revenues, but they're not growing cash flows. They're not growing any type of actual returns with their revenues. I can look at this in terms of the ratios here. The ROCE is -2%, -3%, -9%. And then recently in 2021, it bumped all the way up to 2%. Assuming a cost of capital of around 8%, Spotify has only had negative returns on their actual invested capital. The investor that's investing in this company is believing this is going to increase substantially over time. That's what you have to believe to make this investment thesis work. And I'm just unsure. I'm not willing to wait that long. So I sold out of the company because I realized I just don't want to wait it out. I don't want to wait year after year after year hoping they can turn their business from an economically unprofitable one to an economically profitable one. So that's my big concern with Spotify. In terms of this earnings report, I think it's going to be another one similar to all the previous ones. Growing revenue, growing usership, cash flow is pretty static. Let's go ahead and move on to Wednesday morning. We have Wingstop. The reason that I highlighted Wingstop is this company's interesting to me. I really like these quick service restaurant companies that run a franchise business, and they basically are licensing businesses. So what they do, like Domino's and Wingstop, is they own the brand, they own the design of the locations and the recipes and everything. They might supply the different franchisees with the food, and then they just have franchisees open up as many locations as possible. This is what Wingstop is doing. They're having rapid growth through their franchise business model, and they just collect fees based on the franchise. So you can think of Wingstop Corporation as kind of like the Universal Music Group. And all the franchisees is like the Spotify's in that situation. They're actually getting the customers, making the sales. Wingstop just collects the fees. Now, we look at the revenue growth. It's been very quick. The past year, it was 13%. The past 2 years, 12.5%. The past 5-year CAGR was 21%. So it's a fast-growing company, but the price of it is just too high, even with that growth. A 63 Ford PE ratio, so expensive. It already trades at a 3.7 billion market cap. 3.7. This is a company that only does $285 million in revenue. That's what they did last year. And they're trading at a $3.7 billion revenue. They have a free cash flow yield of 0.38%. When I look at this and compare it to something like Texas Roadhouse, and I know they're different business models. Texas Roadhouse is a restaurant company, not a quick service restaurant. But this one has a 4% free cash flow yield, a $6 billion market cap, and does $3.46 billion in revenue. So I look at Wingstop, and even though the company's great, I'd love to jump into this one. It's on my watch list. It's just too expensive. That is really what I've just come to every time I look at it. On top of that, my biggest concern about this company outside of the price is their balance sheet. They're doing basically the same thing Domino's did, which is to aggressively take out debt and open up as much business as they can. And you can see that their debt has grown to $709 million. They have currently $165 million in cash, which means that they have over $500 million in debt. And again, they only revenue $83 million per quarter. $83 million of revenue, $500 million in debt. They have years and years to pay off this debt. In fact, it's probably going to go up. So this one for me is not a buy right now. I think it has valuation risk. I think it has too much debt. Outside of that, I think the company's great. The valuation comes down substantially. I might jump into it. In terms of this earnings report, I'm going to have to go with my bet that restaurant companies, quick service restaurant, Chipotle, Wingstop, I think these ones are going to do well. I think both of them will beat their earnings expectations. I think they'll give good guidance. After that, let's go ahead and look at Meta, reporting earnings after close on Wednesday. This company is one that's a bit frustrating because I think the valuation is incredible. I think the assets are pretty great, but I don't like the direction that Zuckerberg has taken it with this huge focus on the metaverse, pouring tens of billions of dollars into something that I consider to be a huge long shot. So I don't like long shots in general. That's the reason that I exited out of this company. I like things that I consider to be sure bets. I can count on them working out. I think investors are kidding themselves with Meta, believing that this metaverse is a for sure thing. I think it's incredibly unproven. And even if it does end up working, it's untold of whether or not Meta is going to be the one that ultimately owns the economics of the metaverse. I think if the metaverse does work out to be the next great thing, it's likely to be owned by different companies that have a better connection with consumer products. So that's my thoughts on it. Overall, fundamentally, if there wasn't such a strong focus on the metaverse, I'd probably be invested in this company. Now, it's down huge this year. Expectations are incredibly low for Meta. The company trades at an 11.65 PE ratio, below a commodity multiple, well below the rest of the market. In my opinion, even though I'm not bullish on this company, the expectations are so incredibly low that I think it has more upside than downside. I know investors hate it right now. It has such poor sentiment, but Meta is a highly profitable company. If they can trim back on their metaverse spending and their CapEx just a little and generate more free cash flow, this company does have a ton of upside. So it's just a risky endeavor, but I do think that this next earnings report, if I have to make a prediction, I think it's more likely to have upside than downside. In terms of the long-term trend of Meta, I'm probably not going to be going into this one anytime soon. I think social media companies are generally difficult, and I think this bet on the metaverse, again, is just risky. Let's go ahead and look at Ford here. Ford's another company that I wanted to highlight because it explains a little bit why I'm apprehensive to invest in Tesla. I know that Tesla is a different company because it's a tech company on wheels, right? It's a computer on wheels, and Ford is just an old-fashioned company. But I like to take a step outside and just look at the industry, and I really, really hate the car industry, almost as much as I hate the airline industry. Now, I don't hate working in it. I think if you're an employee in one of these companies, that's fine. But in terms of investments, you just look at these companies and it's just not great. 17% returns in the past decade, highly volatile, unpredictable. It's trading at a 5 PE ratio. Again, growth doesn't matter because they don't capture any of the economics. It's highly cyclical. People don't buy luxury vehicles as much during recessions. They won't be buying high-priced trucks when the cost of capital goes way up. Loans are more expensive. Their income goes down, especially if there's unemployment. This company's really going to struggle. So it's unpredictable, unreliable, low returns on invested capital, and it's highly levered. They have a lot of debt. You're dealing with that as well. And then we look at the long-term returns on capital employed of this company, and again, it's just horrible. On the high end, you're looking at 11%. So bad. It's just a bad company, bad industry. You might be able to make money with it if you time the swings in the market, but not one that I'm ever going to bet on. And I think that Tesla might break this trend. They might prove that they're not just a car company. But again, that's just my overall apprehension. Now, in terms of this upcoming earnings report this week, I'm not overly positive on it. I'm not so sure about Ford. I think the used car market in general is plummeting right now. Prices are coming down. And I think that that's going to affect the new car market. So when Ford's trying to sell new vehicles, the used car prices affect them. And they have to price things accordingly. All this stuff affects each other. So I think cars were way overpriced a year ago. I see margins coming down. I see prices coming down. I see inventories going up. So I don't know if that's going to affect this quarter, but that's what I see going forward. It's one of the industries that I would really avoid right now. I really don't like the auto industry. That's what I've highlighted with Ally Financial. I just don't want any exposure to it. Next up, we have Teledoc. Teledoc is one that I wanted to highlight just as kind of a throw-in company. I know that Kathy Wood is big on this company. You know, I have a brother. My older brother is a surgeon. So he's a highly specialized, highly trained surgeon. He went to school for like 15 years to do all these eye surgeries. And I talked to him about Teledoc because at one point in time in 2021, I was very interested in this company. So I asked my brother about it. Him being a doctor, I thought he might have some insight on telemedicine. And I asked him what he thought about telemedicine in general and investing in Teledoc. And he told me something. He said, Joseph, probably the last company I'd want to invest in is a telemedicine company coming out of COVID. Think about this. It's never going to get ever as good as it was in 2020. That's the best it will ever be for telemedicine. The time that you were literally locked down because of a pandemic, how are you going to ever beat that with telemedicine? Outside of that environment, most people want to go and actually just talk to their doctor. They don't really want to deal with telemedicine. That was his comments on it. Now, I'm glad I listened to him. I didn't hold this company at all. And since that point in time in 2021, it's down around 70% in price. So I think a lot of investors finally caught on to that same thing, that 2020 was basically the best it will ever be for this type of company. Outside of that environment, you're trying to convince people to have medicine over an iPad or over a computer when they rather just drive to their doctor. Now, the company right now trades at less than a $4 billion market cap. So it's come down so much. It's been sold down so much that maybe investors are saying now it's time to jump in. I think this is one that you should wait and see. If this is going to be a great company, if the predictions are true from the Teledoc bulls, the people that still hold strong to this company, again, you can take Peter Lynch's advice and just wait a bit. Wait until they actually start producing real earnings, not this negative net income, right? You can wait it out and see. In my opinion, Teledoc is a prove me company. You have to be proven wrong with this company. I think it's a bad business. I don't think it's going to do really well in the future, but I'm willing to be proven wrong. If I am, I can jump in. And if it's such a great company, you don't have to be the first one in. So you can avoid disaster, a 70% drawdown, by just waiting a little bit until their fundamentals actually get on track. In terms of earnings reports, I have no predictions for this company. I don't know what the analysts are expecting. But the long term, I'm very concerned about this company, and I think it's completely in that category of just wait it out. Wait and see how this one does. Next up, we have Shopify. Shopify is not only a do-it-yourself website builder, but they're also a massive online e-commerce store, and they're also a fintech company that's giving loans to their customers. For example, if you run a big Shopify business, if you're revenuing millions of dollars using Shopify, you can get a loan from Shopify. And the way that you pay them back is they say, we'll just take 2% of your revenue from your transactions until we're paid back. And that way they can give you a very low interest rate because they basically they actually have like a hook on your revenue. They simply take out 2% of the revenue, they pay themselves back. That way they know they're going to get their money back because your whole store, your whole income runs on their platform. So they have this really interesting integration into fintech. And I think that they're one of the good fintech players. So I really like this company. I like the positioning of it. I think it got way overpriced, being at $150 billion market cap. Look at this over the past 5 years. Just incredible. It went up to 168, almost $200 billion. Now it's back down to $28. So it went up too high, came back down. Now we're closer to reality. I actually like where this company is right now. I like the direction of it. I think it's going in a good track. I wouldn't mind investing in this company and holding it for the next 5 years, but this is one that I think is similar to where you want to wait a little bit and make sure that they're going to post real free cash flow in the future. They've done so in 2020, which was kind of unique, but you can see it swinging back negative. So this is one that, again, I'm going to wait until we see the returns come in. Having said that I'm bullish on Shopify, the big reason that I've really avoided this company, again, is because of Amazon. I just view it as two different companies that you have exposure to online commerce, and I think Amazon is the winner. I think they're so much better positioned, such a better company overall. In terms of this earnings report, I think it will be good. I think online shopping has been very good. Shopify should perform really well. If they don't, it'll be very disappointing. Next up, we have McDonald's, a staple in American culture. This company's great. I love McDonald's as a corporation because they're so consistent, so steady. I don't like their product that much. I don't like their food. I just think there's better options. I don't want to trash it too much. I think it's okay. I do like their breakfasts to some extent. I think that's okay. It's passable. But McDonald's is just okay food. You know what you're getting. The big thing with McDonald's is it's mostly consistent. They have the same brand, the same consistency across the country. People know what they're getting. They like their food. They get it out quickly. So it's just got this really good recipe that they've been able to maintain for decade after decade after decade. Such an incredible company. Now, McDonald's is already a mature company trading at a 24 PE ratio. A lot of my comments about CocaCola would fit with McDonald's. So McDonald's, Coca-Cola, kind of two sides of the same coin. They're basically the same type of company. You have your revenues that go up and down, but it doesn't really matter because the free cash flows they produce are consistent, reliable. They can use the free cash flows to either return to the investor in terms of dividends or do share buybacks. So the revenue going up is great, but it's not the most meaningful part of this story. This is a company that just continues to push out high returns on capital employed in the low 20s to upper 20s. That's a good range to be in. That's right where like Texas Roadhouse, Costco, and other companies are. As long as they can continue to do that, this company will generate good returns for the shareholder. It'll be less volatile. It'll be a very defensive company. I think McDonald's will outperform the market over the next 10 years. That's my thoughts on it because of how resilient this company is. Now, in terms of this earnings report, I'm once again going to have to reiterate, I could be wrong on this, so we'll see. I can't see the future, but I really think these restaurant food companies like McDonald's are going to do really well. I think Wingstop, McDonald's, Chipotle, I think Texas Roadhouse, I think these food companies are going to crush it this quarter. Let's see. We'll wait and see, but that's my prediction. When I drive past McDonald's, just look at the lines. McDonald's lines are usually pretty long. They're usually pretty full. Now, next up, we're getting into the behemoths, Apple and Amazon. Let's go ahead and start off with Apple here. Apple, my prediction is their earnings report will be expectations. Now, I own this company. I'm invested in it. I'm very bullish on it. Whether or not they beat this earnings this season doesn't really matter to my long-term thesis. My long-term thesis of Apple is that it's a consumer staple company disguised as a tech company. So it's basically a consumer staple. Everyone needs to have their iPhone. You're not going to leave the house without it. It's part of your identity. It's part of your life. It's something that people just don't forget because it's so necessary. And the same could be said for Android as well. But I think Apple has carved out this consumer staple need. It's defensive. Meanwhile, they capture a lot of the economics. So it's like a better version of Coca-Cola, in my opinion. That's how I see the company. There are risks to the investment. If they go through a string of bad products, I think that's a risk, but I think it's unlikely. And most reports, most Surveys show that kids love their Apple products. They want to get the same iPhone next year. They just want to keep upgrading. So that's my assumption on the company. It's down a little bit this year. I think it's priced for more upside than downside at a 22 forward PE ratio. I think that investors have convinced themselves to be scared, but Apple's earnings reports are very difficult to predict. A lot of times after the earnings, the stock drops, even though they beat, because of some new concern. There's always something to be worried about with Apple. The next release of this product and the next release of this product, right? There's always something to be concerned about. What I would say with Apple, when I look at this company, it's true that there's variance with how popular a specific product will be, but I think the overriding theme here is that they're becoming a software subscription company. The amount of money they make in software subscriptions through Apple TV Plus, through the music, through gaming, through their whole app store, is making up a bigger and bigger portion of their free cash flow. Last year, they posted $92 billion in free cash flow, so they can just buy back shares and do the same thing they've always done. So in terms of this earnings report, I'm going to make a prediction that Apple beats on their earnings and their revenue. They give no guidance, so investors have to fill in the guidance, and I think that investors will find something to be worried about. That's my prediction. That's usually what I see happening with Apple. Their performance historically is great, but investors are worried about something in the future always. That's how the company has done. And then if you look over time, the performance historically is just always great with this company. So we'll see, but that's my prediction on Apple. Next up, we have Amazon, another company I'm heavily invested in, very bullish on this company. I think it's heavily underpriced right now. This one is inherently difficult to predict what direction the earnings report will come in because of the amount of operating leverage the company has. Operating leverage means that little changes in the amount of revenue this company earns actually has dramatic changes in their amount of free cash flow. So if they earn a couple more $1 billion in revenue on the base of a $469 billion revenue company, just a couple $1 billion of revenue extra with their fixed costs can go straight to the bottom line. And likewise, if they come in a little bit lower, the revenue that they lost is taken away from the bottom line. So the operating leverage is very huge with Amazon, and that affects their cash flows to a huge extent. I think that's part of the reason you see big swings, like in 2020 having $26 billion of free cash flow, then in 2021 having minus 15. So overall, it makes it very difficult to predict. Analysts have a tough time gauging what Amazon's earnings are really going to be. On top of that, in terms of the EPS, we have Rivian that affects that as well. You have to take out the Rivian stake. So there's a lot of moving parts. There's so many different things that they throw free cash flow into. I think in my prediction, and again, I own a lot of the stock. I'm bullish on the company long term. I'm not going to trade out of it depending on this earnings report unless something really went catastrophically wrong with the fundamentals. But if it comes in a little bit under, it doesn't change my long-term investing thesis. If it comes in a little bit over, it also doesn't change it. But my prediction is that Amazon will come in above expectations. Overall, I think all of the actual fundamentals, the core businesses of Amazon, are doing exceptionally well. I think the ads business is growing. I think it's more insulated than Google's, Meta's, or Snapchat's. So I like the ad business even more than Google's. I think the Prime subscription is growing in membership. I think that members are very happy with the value proposition of it. Consumers are happy. I think AWS is likely growing. It might decelerate a little bit, but I think it's still growing to a huge extent. And I think that the retail business is actually doing quite well. I think they probably made good sales and are going to project a good upcoming quarter. So I wouldn't be surprised if Amazon outperformed analyst expectations. If it doesn't, I'll likely still remain invested because, again, this is a long-term hold. I'm viewing this one over a 10-year basis. But that's my prediction on Amazon. Let's go ahead and talk about Intel here. Intel's a company that I'm not invested in currently, and I'm not likely to invest in the future, even despite the valuation of fundamentals, because I don't understand the industry as much as I'd like. So it's outside of my circle of competence to invest in these type of chip makers and manufacturers. Now, I've been studying them more over time, so I've been learning about this industry, but I just think it's too cyclical, too unpredictable. They have contracts with different companies. They can have big partners move away from them like Apple and make their own chips. And that makes it a little bit less predictable for me. And again, I like companies that I consider to be more of a sure thing than long shot, unpredictable companies. I'm going to leave it as an unknown. I really don't have any prediction on what direction Intel's going to go. It could surprise to the upside, surprise to the downside. I don't know. Don't have a clue on that one. So that's it. That's my predictions. We'll see how this turns out. I think this is going to be a very, very interesting week. It has huge implications on the next 3 months of the market. So that's my thoughts for now. Hope you enjoyed the video. I'll have reaction videos to many of these earnings reports right after they happen. So if you haven't already, subscribe to the channel, hit the little bell icon for the notifications. I'll see you in the next one.